Stop what you're doing, because if you blink, you'll miss the moment the entire money game flips on its head. Silver didn't just move, it lunged. And if you're still thinking this is just another rally, you're playing checkers while somebody else is stacking the board for chess. Quick thing before we go any further. We've got 1,000 plus members who get daily members-only videos and early access to every video on this channel, so they stay fully updated with the market. If you want to stay updated like them, consider joining. Just click the link in the description or tap the join button below. It won't take more than 30 seconds. Now listen, today we're kicking off a simple giveaway, 20 ounces of silver. To enter, just like this video, subscribe, and drop a comment with either your favorite type of silver or your price prediction for this year. That's it. End of the month, we'll pick a winner on a live stream and I'll announce it on camera. Easy. But the giveaway isn't the point. The point is this. When silver prints triple digits while the world still looks normal, that's not entertainment. That's a warning label. Because here's the weirdest part. Your groceries still ring up, the stock market still pretends it's invincible, and most people are still walking around like nothing's changed. And yet, something changed. From recent market updates, silver is hovering around $115 an ounce, after tagging even higher intraday. Gold is sitting north of 5,200. That's not a typo. That's a signal flare. So the question isn't, did silver go up? The question is, why did it go up before the obvious crisis showed up on the evening news? Hold that thought, because in a minute I'm going to tell you the one clue almost everyone is ignoring. And it's the clue that determines whether this is a temporary spike or the opening scene of a completely different decade. Before we get there, you should know the description has bonus links, including a premium WhatsApp channel link and a channel membership join link. If you want the quick updates and the deeper dives, those are there. Also, premium members get members-only videos produced by a separate team. More research, more structure, and more detail, only for premium members. Keep that in mind because the next few months are going to reward the people who prepare, not the people who react. All right, let's talk about what just happened, without the hype, without the panic, and without the lazy to-the-moon nonsense. I brought on a friend of mine, someone who lives in the world of money mechanics, not just price charts. And the first thing I said was, tell me I'm not crazy. We're up huge and I still feel uneasy. He laughed, but it wasn't a happy laugh. He said it feels like watching a storm roll in while everyone's still setting up picnic chairs. Because when silver goes vertical, it's not really silver winning, it's the dollar losing. And that's a brutal distinction that a lot of people still don't get. If silver goes to 150, but your rent doubles, your insurance triples, and your paycheck buys half as much, did you profit or did you simply keep your head above water? That's why I keep saying, don't obsess over how many dollars your metals are worth. Focus on what your dollars are becoming. And right now, the dollar is becoming smaller, faster. According to the latest publicly available filings and policy schedules, the central bank is sitting in that mid-range interest rate zone, high enough to squeeze, not high enough to cleanse. It's like they put the pressure on and then act shocked when something cracks. We even talked about what would make this feel like the real endgame, and his answer was simple. You'll know it's the endgame when the next full-blown rescue round hits. Not a quiet, backdoor liquidity tweak. Not a technical adjustment. I'm talking about the moment they slam rates back towards zero and shove fresh trillions into the system because the banking plumbing starts choking again. That's when the calm mask slips. And here's the cliffhanger. Silver just made a move that usually shows up after that kind of rescue. So why is it happening before? That's the question that should keep you awake. Because if silver is front-running the bailout, it means the people closest to the pipes are seeing something the rest of the crowd can't see yet. And no, that doesn't automatically mean tomorrow the world ends. But it does mean the risk meter just climbed. Now, I want to challenge something that gets said a lot in precious metals circles, including by people I respect. You'll hear, paper metals won't matter, only physical counts. Derivatives will go to zero. Here's my take. In a true breakdown scenario, yes, counterparty risk becomes a monster. A promise is only worth the system enforcing it. But it's also true that markets can stay functional longer than people expect, and paper exposure can still be useful as a bridge. So I'm not here to preach one size fits all. I'm here to say, understand what you own, understand why you own it, and understand what conditions have to exist for it to work. Physical metals are about sovereignty, a hedge you can hold. Paper exposure is about liquidity and flexibility, until it isn't. The danger is not owning an ETF. The danger is thinking an ETF is the same thing as a stack in your hand. Those are two different animals. And the faster prices move, the more that difference matters. Now let me tell you what my friend said that hit me like a brick. He said, This is separating the people who are investing from the people who are exiting. That's the cleanest way I've heard it. Some people buy metals to try to grow their account balance. Other people buy metals because they don't trust the measuring stick anymore. And when the measuring stick starts bending, the second group stops caring about the daily quote. They start counting ounces like lifeboats. But here's the twist. Even if you're in the exit camp, you still have to deal with one practical reality: volatility. Because silver doesn't rise like a staircase. It rises like an elevator with a broken cable. Up fast, down fast, then up again. We talked about corrections, and I'm going to be honest with you. A sharp pullback wouldn't shock me at all. In fact, it might be the most normal thing in the world. What matters is not whether a correction happens. What matters is what happens after the correction. Because there's a kind of correction that's just a breath, and there's a kind of correction that's the last chance. And you don't get to know which one it is until it's already behind you. If you're successful, share your success story in the comments so others can stay motivated. Now, let's get into the part that confused a lot of people today. Why are there different prices depending on where you look? People kept messaging me saying, the paper quote is here, but the real-world physical price over there is higher. So I asked him straight, is this a shortage? Is the market cracking? What's the deal? He didn't pretend to be an industry insider. He framed it the way a monetary thinker would. He said there are basically multiple silver markets that only look like one market when times are calm. When times get tense, they start drifting apart. One market is the retail coin world, people buying coins because they want something they can actually hold, trade, and keep close. Another market is the industrial world, companies that need specific forms of silver for manufacturing, not a pile of old coins. And another market is the futures and warehouse world, contracts, delivery rules, inventories, and all the legal machinery that keeps spot feeling like a single number. In calm times, those lanes run parallel. In stress times, they start pulling away from each other. Because an industrial buyer can't just show up with a bucket of mixed coins and say, here you go, make my components. They need refined product. They need bars of a particular purity. They need supply chains that deliver on schedule. So even if the retail coin premium looks tame, the industrial premium can get ugly. And when manufacturing hubs are fighting for supply, they'll pay up, because the cost of not getting the metal can be bigger than the cost of paying a premium. That's how you can get a world where one price is on a screen and another price is what the desperate buyer actually pays. And the moment those prices start drifting, it tells you the market's plumbing is under strain. Now, here's a retention cliffhanger for you. If the split between those lanes widens, it doesn't just affect silver. It affects everything priced in dollars, because it's a live demonstration that the quote is not always the reality. And when people learn that lesson at scale, money psychology changes fast. That's why I'm watching not just the headline price, but the behavior around it. Now let's step back and ask the uncomfortable question. Is this move happening because we're already in the endgame, or is this a preview? My friend leaned toward preview. He basically said, the world isn't panicking yet. We're not seeing the obvious symptoms that show up when a currency breaks in public. You're not seeing empty shelves. You're not seeing full-blown daily price repricing at the checkout counter. You're not seeing a mass stampede into durable goods. So if those things aren't happening, why is silver acting like they are? And that's when he said something that made me stop talking. He said, if silver can do this when the public is still asleep, imagine what it does when the public wakes up. That's the kind of sentence that sits in your chest, because it suggests the move you're watching might not be the big move. It might be the trailer. Now, to keep this grounded, let's talk about what could create a pullback. He described a pretty logical sequence. When prices explode, big industrial players and leverage players start scrambling. Some buy because they truly need supply. Some buy because they fear they won't get supply later. But those same players often have debts and obligations denominated in dollars. And when financial conditions tighten, those obligations don't disappear. So you can get a moment where the system demands dollars, hard, a dollar crunch. And in a dollar crunch, even people who love silver might sell silver to raise dollars. Not because they suddenly hate silver, because the system forces their hand. That's how you get violent downswings. And that's why I refuse to tell you it will only go up from here. Anyone promising you that is selling you comfort, not truth. Here's the real truth. I don't know the exact top of the next spike, the exact bottom of the next dip, or the exact day the next policy pivot hits. And neither does anybody else. But what I can do is map the logic. And the logic says this: the more fragile the dollar system becomes, the more valuable real assets become, and the more chaotic the path between here and there gets. So how do you navigate that? You stop treating metals like a lottery ticket. You treat them like insurance. Now, at this point in our conversation, I asked him the question I know you're thinking. Okay, if somebody is brand new and they're watching this right now and they feel late, What should they do? And his advice was almost boring, and that's why it was good. He said, don't try to time your first step. Get a first tranche. Start small if you have to, but start. Because the goal isn't to win a perfect entry. The goal is to not be empty-handed if the system has a seizure. Then he said something else that I want you to tattoo on your brain. Once you've got your base position, stop staring at it. Stop doom scrolling. Stop refreshing the price every 10 minutes. Build your life. Build your skills. Build your income. And check back when you have new money to allocate. Because obsession turns preparation into panic. And panic makes you do dumb things. Now, I'm going to add my own layer on top of that. If you're new, don't let a triple-digit quote trick you into thinking silver is expensive. Price is not the same as value. A high quote can be the symptom of a sick currency, not an overvalued metal. So instead of asking, is it too late? Ask, what problem am I trying to solve? If you're trying to solve the problem of currency debasement and purchasing power erosion, then the question isn't whether the quote is high. The question is whether the policies that cause this are stopping. And based on recently published numbers and statements, the confidence in the dollar is not exactly getting stronger. Now, I know some of you are thinking, John, you're being dramatic. Am I? Let's be sober. Gold pushing above 5,200 isn't a normal Tuesday. Silver holding around 115 isn't a normal Tuesday. And the wild part is, it's not even being treated like an emergency by most people. That mismatch between market behavior and public mood is what makes this situation so explosive. Because when the public mood finally catches up, moves tend to accelerate. Now, let's talk about the gold to silver ratio because it matters for context. It's been compressing, meaning silver has been outperforming gold. In plain English, silver is getting stronger relative to gold. That can happen for a couple reasons: monetary demand, industrial demand, speculative pressure, or all of it at once. And when all of it hits at once, you get what we're seeing, a violent repricing. But I'm going to give you a counterpoint to keep you from getting hypnotized. A falling ratio doesn't guarantee a straight path. It can overshoot. It can snap back. It can fake you out. So if your entire plan is built on a ratio going to some magical number, you're building on sand. Instead, use ratios as thermometers, not prophecies. Now, let me pull you into a story he told, because it's the perfect emotional anchor for what we're living through. He remembered his first serious silver buy, back when silver was in the 20s. He said he bought, and then watched it go nowhere for years. And that's the part nobody wants to hear during a mania. Patience. Because the thing about preparation is, it's boring until it isn't. Then it looks like genius. I told him my first buy was around the high teens in US terms, and I remember the same feeling. You buy, you feel smart for a week, then the market forgets you exist. But the market has a way of rewarding the people who can sit still. Not forever, just longer than the average attention span. And right now, the average attention span is about 8 seconds. That's why I'm telling you, if you're here because silver is trending, fine. But don't leave when it stops trending. Because the moment everyone stops watching is usually when the real positioning happens. Now, I want to pivot into something that gets ignored in these conversations. What does this mean for your day-to-day life? Because if the only outcome you care about is a bigger number on a screen, you're missing the real story. When metals scream higher, it's often a reflection of trust breaking down. Trust in purchasing power. Trust in fiscal discipline. Trust in the idea that savings will be rewarded. And when that trust breaks, it changes behavior. People stop lending. People stop holding cash. People start moving into things that can't be printed. And that shift is what drives the second leg of the move, often the bigger leg. So the question I'm asking you is this. Are we in the first leg, where the smart money moves quietly? Or are we in the second leg, where the crowd stampedes? Drop your answer in the comments. Are we early, or are we late? And here's a second question I want you to answer, because it'll tell me a lot about where your head is. If silver suddenly pulled back 20 or 30%, would you see that as a disaster or as a gift? Be honest. Comments are open. Now, because a lot of people are feeling emotional, I want to slow the heartbeat for a second and talk fundamentals, without turning this into a boring lecture. Silver is weird because it's both a monetary metal and an industrial input. That means it gets pulled by two different engines. The monetary engine is fear, trust, policy, and psychology. The industrial engine is factories, supply chains, and real-world demand. When both engines rev at the same time, the price doesn't politely rise. It snaps. And you can feel both engines revving right now. The monetary side, gold breaking records, the dollar weakening, uncertainty rising. The industrial side, ongoing demand for electronics, energy infrastructure, and high-spec manufacturing that can't just substitute silver away overnight. Now, I'm not going to pretend silver is the only answer. Real estate, productive businesses, skills, and cash flow matter. But silver is one of the clearest mirrors for what the currency is doing. And the mirror is showing you something ugly. Now, here's the part you need to hear if you're feeling FOMO. FOMO is how people buy the top of the short-term spike. Not because they're stupid, because they're human. They see a chart, they feel urgency, and they press the button with shaking hands. So, if that's you right now, pause. Go back to first principles. What percentage of your net worth do you want in hard assets? What percentage do you want liquid? What's your timeline? What would make you sell? If you can't answer those questions, you're not investing or preparing, you're gambling. And gambling gets punished in a market like this. Now, let's talk about the endgame concept, because it gets thrown around like a meme. Endgame isn't a date. Endgame is a sequence. It's a chain reaction where one policy move forces another, one bailout forces another, one confidence break leads to another. And eventually, the system becomes addicted to its own medicine, and the dose has to keep increasing. That's what hyper-unstable systems do. So when my friend said, "We're not there yet," I understood his caution. But when he said, "We're heading there," I understood his conviction. Because we've seen this movie in pieces throughout history. Currencies don't usually die in one dramatic explosion. They die in episodes. A crisis, a patch, a calm, another crisis, a bigger patch. Each patch makes the next crisis worse, until the patch doesn't work. Now, you might be thinking, okay, but what's the catalyst this time? That's the dangerous question, because people want a single trigger. In reality, it's usually multiple stresses stacking at once. Debt servicing costs, political pressure, trade imbalances, bank exposure, consumer confidence cracks, employment data shifts, and then the thing everyone thought was manageable suddenly becomes urgent. Based on recently published numbers, the mood around the dollar has been wobbling, and you can see it in how aggressively safe haven assets are being bid. But here's my skeptical alternative perspective. Not every metal spike equals immediate collapse. Sometimes metals spike because positioning is thin. Sometimes they spike because speculative flows avalanche. Sometimes they spike because the market is front-running a policy decision that ends up being less dramatic than feared. So yes, respect the signal, but don't let the signal hypnotize you. Use it to tighten your plan. Now remember earlier I teased the one clue most people are ignoring? Here it is. The clue isn't just the price, it's the timing. Silver and gold are acting like a major policy pivot is around the corner. And when markets act like that, they're either early or they're informed. We're literally sitting on a central bank decision window right now. And even if the official line is steady, the market is sniffing something else. Maybe it's future cuts. Maybe it's future liquidity. Maybe it's stress behind the curtain. Whatever it is, the market is not waiting for a press conference. It's moving first. And if you wait for the press conference, you're always late. That's why I'm telling you, watch actions, not words. Now I want to address the people who say, I'll just wait for the pullback. I get it. That feels prudent. But here's the trap. If you wait for the pullback and the pullback never comes the way you want it, you end up doing nothing. And doing nothing is still a decision. So instead of all in now or wait forever, consider a middle path, scaling. Buy a little, then a little more on dips, then a little more when you can. That approach removes the emotional pressure of picking the perfect bottom. Now, because this is YouTube, I have to say this. Do not confuse a strategy with a guarantee. Scaling doesn't protect you from volatility, it protects you from paralysis. Big difference. Now, let's also talk about the "it's too high" argument. There are two ways a price becomes too high. 1, the asset gets overvalued relative to reality. 2, the currency gets devalued relative to reality. Most people only understand the first, but the second is what matters in an era of endless policy improvisation. And that's why metals can look crazy while actually being perfectly rational. If the measuring stick is shrinking, the numbers rise. Now, I promised you cliffhangers, so here's another one. If silver can hit 115 with no obvious public panic, what happens if the next banking headline hits on a Monday morning? Do you think buyers calmly wait for a dip? Or do you think they smash the buy button like it's a fire alarm? That's why these moments matter. They're not just about price, they're about behavior. Now, we also hit on something practical that I want to share. In a fast market, people get tempted by complex plays, leverage, options, exotic products. And I'm not here to moralize, but I will warn you. Complexity is a multiplier. It multiplies gains. It multiplies losses. It multiplies stress. If you don't already have experience managing that stress, a market like this will humble you. Hard. So if you're new, keep it simple. If you're experienced, stay disciplined. And if you're emotional, step back. because the fastest way to lose money in a metals mania is to treat it like a video game. Now, I want to circle back to something he said about after the final correction, that's it. That's a dramatic statement, and it sticks because it's scary. But here's my refinement. The final correction is only final if the system's credibility is broken beyond repair. And credibility breaks when people stop believing the promises. Promises like, we'll control inflation. Promises like, your deposits are safe. Promises like, we can normalize later. So watch credibility. Because when credibility goes, the market doesn't politely reprice. It stampedes. Now, I'm going to give you one of my personal rules for moments like this. I never assume the first big move is the last big move. Markets love to shock you, then bore you, then shock you again. They'll spike, then chop, then spike harder. And they do that to transfer assets from impatient hands to patient hands. So if you're feeling euphoria, you're at risk. If you're feeling despair, you're also at risk. The goal is to feel calm. Calm people make decisions. Now, let's do a quick recap of the core idea for the people who are just joining and need the headline. Silver is exploding not because silver is suddenly better, but because the currency and trust environment is deteriorating. Physical and paper markets can diverge when supply chains strain. Corrections are normal, but the post-correction behavior is what matters. And the timing suggests the market is anticipating policy stress or liquidity shifts. That's the map. Now, here's the part where I speak directly to the person who is scared. If you're watching this at 1:31 in the morning like I am, and your stomach feels tight, I get it. Because money touches everything. It touches your family, your future, your dignity. And when money feels unstable, life feels unstable. So don't let this become an anxiety loop. Let it become a planning moment. Make your budget real. Cut the waste. Build your emergency fund. Reduce bad debt. Add a measured amount of hard assets. Invest in skills. Because the endgame isn't won by the person with the spiciest tweet. It's won by the person with the strongest foundation. If you're successful, share your success story in the comments so others can stay motivated. Now, I'm going to bring this home with one more story that illustrates why timing can be overrated. During a past crisis dip, my friend told his father to buy some silver, not because it was guaranteed to bounce next week, but because it was cheap insurance. His father bought, paid a premium because demand was crazy, and then time did the rest. That's the mentality. You're not buying a lottery ticket, you're buying optionality. And optionality matters when systems wobble. Now, since I'm recording in the middle of the night, let me give you the what I'm watching at sunrise framework, because the next 12 hours matter more than the last 12 days. First, the central bank. There's a decision window today, and even if they don't change rates, markets don't just react to what they do. They react to what they hint they'll do next. If the language shifts even slightly toward, we're worried, metals can treat that like permission. And if they sound stubborn, metals can still run if traders think something breaks anyway. Either way, the market is daring policymakers to keep their foot on the brake while the engine is overheating. By the way, the interest rate target everyone's watching is still sitting in that 3.5 to 3 3/4 zone. That's tight enough to squeeze borrowers, but loose enough to keep the debt machine breathing. If they even hint at easing, metals can sprint. If they don't, something else might snap. Either outcome keeps volatility, and that's the point. Second, the dollar. You don't need a PhD to understand this. When the dollar drops, commodities priced in dollars usually rise. But what's happening now feels more psychological than mathematical. It's not just FX moves. It's people asking quietly whether holding cash is still a smart default. That's when gold and silver stop behaving like trades and start behaving like lifeboats. Third, the spread between screen price and get it in your hand price. If coin premiums stay calm while industrial premiums jump, that tells you the stress is in supply chains, not retail panic. If both jump together, that's when the crowd is waking up. And if premiums collapse while spot stays high, that can be a sign that the spike is mostly leverage. Each version tells a different story. Fourth, what happens after the first gut punch pullback? This is where people get tricked. A violent dip can feel like the party is over, but sometimes it's just the market clearing out weak hands before the next shove higher. Watch the bounce. Does it snap back fast, like buyers are waiting? Or does it drift, like demand evaporated? The answer is the difference between a temporary fever and a structural repricing. And here's the part most people won't like. Even if your long-term thesis is right, you can still get wrecked short-term if you size it wrong. That's why I keep repeating this boring sentence. Plan your position so you can sleep. If your metals position makes you stare at the ceiling, it's too big, or your cash buffer is too small, or both. Also, let's talk about the silver is only up because of hype argument. I don't buy that. Hype can move price, sure, but hype doesn't manufacture new industrial supply. Hype doesn't create more refined inventory. Hype doesn't magically replace silver in high-performance electronics overnight. If demand is real and supply is tight, hype just lights the fuse faster. At the same time, I also don't buy the opposite extreme, the idea that every tick up is proof of immediate dollar death. The system can limp, patch, and stagger longer than the internet thinks. So my posture is simple. Stay alert, stay humble, and stay positioned. But don't get intoxicated. One more thing, because I know a lot of you are thinking about, what do I do with gains? If your metals jump and you feel richer, don't rush to celebrate. Ask yourself, did your purchasing power improve, or did the scoreboard change? If you're going to take profits, do it for a reason, like paying off high-interest debt, building a cash cushion, or shifting into another hard asset you understand, not because you're bored. And if you're holding, make peace with the idea that the path will be messy. That's not a bug. That's the nature of silver. All right, now watch what happens next, because the next headline could make today look like a warm-up. I'll end with this. Don't let a soaring price distract you from the real message. The message is that the old rules are getting rewritten, quietly. First in markets, then in headlines, then in your daily life. If you understand that sequence, you won't be surprised. And if you aren't surprised, you won't panic. And if you don't panic, you'll be ahead of most people. I'll see you in the next video. This video is for education and perspective only. I'm sharing how I think through fast-moving markets, not telling you what to buy or sell. Make choices based on your own situation, your own risk tolerance, and, if needed, a qualified professional you trust.